Is the housing market definitely going to crash? In this video, we're going to answer that question. After all, mortgage rates have gone from a sweet and juicy 2.6% for a 30-year fixed rate loan, all the way up to now the national average of about 5.6% for that same 30-year fixed rate loan. That 3 percentage point difference tends to translate to about 30% in buyer purchasing power. So, does that mean we're going to see a 2008 style real estate crash? Are real estate prices even going to come down at all? That's what we're going to talk about in this video. But remember that before the price goes up, you can get 50% off on any of the programs on real estate investing, property management, do-it-yourself rental renovations. You join our Lowe's partnership, you get our deal analysis, you learn about wedge deals and buying properties hundreds of thousands of dollars under market value, how to build your wealth quickly and in a real manner, not a speculative manner. How can we actually build our wealth? You also get prescriptions in terms of do this and not that to make sure you have the greatest chance of success. Check out those programs linked in the description down below and make sure you use the 50% off coupon code before the price goes up, because we constantly add value and anyone who's already joined the course benefits from that value for free. So the sooner you join, the more value for dollar you get. So at first glance, we're starting to see some of the signs that prices may begin to cool. Not only are we seeing inventory levels shift to the upside, and we're seeing inventory growth year over year shift in a dramatic fashion, especially in the West, where in many states in the West, housing inventory has increased anywhere between 40 to 100%, though we're not seeing as much of that shift in the Northeast. At the same time, if we look at the average list to sell ratio, we're starting to see the white line, or 2022, rotate to the downside. We're also starting to see the percentage of active listings with price drops increase throughout the entire country and in specific areas like Seattle, Miami, Florida, San Francisco, Boise, Idaho, and places like Austin, Texas, areas that have been previously very, very hot. And so when we combine all of these aspects, we look at, okay, well, a 3% increase in rates, that is going to reduce buyer purchasing power. We've got inventory that is starting to go up. As inventory goes up and there are less potential buyers, there's more competition. And so in order for a property to sell, we tend to have to see price drops on active listings increase. And we've seen all of these. Rates have gone up. Buyers have gotten canceled out of the market. We've actually seen cancellations up 15% year over year. This is a substantial increase in the number of cancellations and potentially represents just the beginning of people losing their purchasing power, but then also the opportunity for them to have much more choice, because as inventory skyrockets and people have more choice, they might think to themselves, well, if I wait longer, I don't have to FOMO. In fact, now I just have not fear of missing out, but I have fear of getting screwed, so I'm going to sit around and wait to see how this plays out. So we've got cancellations going up, we've got rates going up, we've got inventory going up, we've got price drops going up on active listings. The next thing that is likely to happen is we're actually going to start seeing close prices. As once deals actually close, we're expecting to see those closing prices finally start rotating down. And then if you get people like Tucker Carlson talking about how month over month home prices are actually falling in addition to inventory going up, then you could create actual panic. But I hate using the phrase, this time is very different from 2008. In 2008, we had a substantially larger percentage of people on adjustable rate mortgages, in the neighborhood of 30 to 40%, who actually had massive impacts of interest rates going up. Now we're closer to 5 to 7%. We also now have qualified mortgages, and the average credit score of a home buyer is about 100 points higher than it was in 2007 and 2008. And we no longer have no income, no job, no asset loans or ninja loans with teaser rates and crazy high adjustable rates when the teaser rates expire, leading people into foreclosure. We're also in a place now where, yeah, foreclosures are starting to go up, but they're actually going up to levels that are substantially lower than where we were prior to the pandemic. So is it possible that the housing market won't crash, that maybe it'll just soften? And the answer to this, in my opinion, has to do with the trajectory for the the 10-year Treasury yield, because mortgage rates tend to follow the 10-year Treasury yield. If Lowe's is right and we had excess demand of 27%, and buyer purchasing power has just been reduced by 30% via interest rates going up 3%, then we can kind of wash out that excess buyer purchasing demand with that reduction in purchasing power and potentially get to a state of economic equilibrium in the housing market, which basically means flat prices for the time being, but not necessarily a crash. And the only way I would foresee a larger kind of correction is that mortgage rates continue to trend up, which is possible. If the 10-year Treasury goes from 3% to 4% because folks perceive the Fed as having lost control of inflation, and inflation numbers keep going up, then we could see mortgage rates go to the direction of 6.5% to 7%. This would decrease buyer purchasing power an additional 10 to 15%, which could correspond to an additional decline in home prices of 10 to 15%. If on top of that, we then compound this with the fear or panic of the mainstream media talking about home price reductions, it's entirely possible that we could see price reductions in the neighborhood of 20 to 25%, which would basically take us back to levels of right before the pandemic. So that kind of bubble run of the 2020 and 2021 years would sort of evaporate with a correction of about 20 to 25% in real estate prices. But again, this would, in my opinion, really require that Treasury yields stay high longer and potentially go up even more. Now, while this is absolutely possible, analysts over at Goldman Sachs don't necessarily think the trajectory is that rates are going to explode. We're currently sitting at about 3.2% for 10-year Treasuries, and they expect that 10-year Treasuries will run up to about 3.3 and kind of stay flat around 3.15 for the next couple of years. Next couple of years, having rates around 3.15% means that maybe for the next 2 years, mortgage rates are stable around 5.5%. But if that just brings us to an equilibrium market, it might not be enough of a push to the downside to actually get home prices to substantially fall. Again, we'd probably need to see somewhere around 6.5 to 7% for maybe a year and a half to really see home prices start getting pushed into that -10 to -20% range, maybe even as much as -25, in case we get a FOMO cycle, or rather I should say a real fear cycle, not fear of missing out, which is FOMO, but just straight up fear cycle, right? Now, there is a caveat to this. We expect rents to stay high. Now, this can do two things. If rents stay high, they might increase the number of people who want to invest in real estate. So you get more investors investing in real estate, means more bottom feeding if prices start ticking down, which actually helps prices stay up again because you're introducing that new buyer demand as rents increase, more people going in to buy real estate. However, higher rents could mean that the owner's equivalent rents, which are the measure or the measures of inflation related to the consumer price index for rents, if that owner's equivalent rent stays high and rents continue to go up in CPI, where rents make up 33% of the inflation rating, then the Fed might actually have to get more aggressive and increase interest rates more, potentially leading mortgage rates to finally go up to that 6.5 to 7% range. And that's how we get our real estate price fall. But if the Fed doesn't react to high owner's equivalent rents and you get more investors buying because rents are up, then you could be in a situation where you actually do have flat or modest appreciation in real estate. There's no guarantee that with certainty real estate prices are going to go down. Now, some folks are saying, hey, you know what? How do I apply this to myself? Well, there are a few trains of thought. Number one train of thought is if you own real estate, you just hold. And the reason you hold is every time you sell real estate, you're going to pay somewhere between 7 to 10% in fees, and then you're going to pay your capital gains taxes on top of that, either long or short term. So you could be spending a lot of money dumping real estate when you're not necessarily guaranteed to see a decline in prices. And this is why a lot of folks say hold, and a lot of other folks say, hey, while I hold, why don't I just pull a bunch of equity out? Which is another thing that we're seeing, is households in Q1 of 2022 withdrew the most equity that we have seen withdrawn since 2007. So obviously people are preparing with cash, which is one of the best hedges in an uncertain and recessionary, style of market. So one idea is hold and maybe just refinance to take out cash tax-free and prepare using real estate as a piggy bank. Other folks who have not bought real estate yet say, you know what, I'm going to wait until I find some fearful sellers. And if I find some fearful sellers, maybe I can buy one of those fearful properties, get a little bit of a discount. Maybe we don't necessarily have market-wide price decreases, but we have opportunities to buy good deals because people are fearful that real estate prices will be coming down. That's a potential as well. The third option, which is the most risky, is to sell and either wait, or what some people are doing is they're selling and then they're buying stocks. And the reason they're doing that is because stocks have already compressed substantially. And even though stocks might compress a little bit more, by some accounts anywhere between 4 to 10% further compression, a lot of folks say, hey, well, if I could go from the top of the real estate cycle to a temporary bottom in stocks, let me load up in stocks. And then who knows, maybe in the future, what will actually happen is we'll actually see stocks rebound. Maybe they'll go down again a little bit, but we'll actually see stocks rebound. And that rebound could happen at the same time as real estate prices fall. So if real estate prices were to compress that 10 to 15%, and then stocks were up, let's say, 40% or 50% here, well, now what you've done is you've moved from real estate at the top to stocks at a low, and then you potentially go from stocks at a higher level to now real estate at a lower level. Now, that is extremely advanced, and I don't recommend it for anyone because this is essentially timing the market. And even though it is possible to time the market, it's a lot easier to do so with real estate. It is very, very risky, and you expose yourself to a lot of taxation risk as well. But this is the point of the video where the most important thing to think about is get educated. Join the programs on Building Your Wealth, link down below. Learn everything that I know about real estate so that way you can take a small investment and turn it into hundreds of thousands of dollars in real estate. Consider checking out the opportunities to invest in real estate, link down below. Check out the programs, use the coupon code, and we'll see you in the live streams and in the lectures where we will teach you everything we know about real estate. Thanks so much.